Welcome back to Power Breakfast on CNBC-TV18. Let's move on. The RBI has released a financial stability report last evening. Now, this is showing a rise in bad loans and warned about the sharp increase that one is seeing in terms of write-offs at private banks. Ritu is bringing us more from the central bank's recent stress tests.
I'll start with some of the key risk areas that RBI has flagged off in the Financial Stability Report, starting with the retail loan segment, where RBI points out that while the retail segment gross NPAs at 1.2% are stable so far, the bad loans in the unsecured segment are higher at 1.7%, with more than half of retail loan slippages across the system coming from the unsecured segment. But what's more concerning, says RBI, is the sharp rise in retail loan write-offs, particularly by private sector banks, which could be masking deeper issues like bad asset quality and weaker underwriting standards. Microfinance is another area under strain. Stress assets, those overdue between 31 and 180 days, more than doubled in just 6 months, rising to 4.3% as of September. And borrower indebtedness is also climbing. RBI says nearly 6% of borrowers now have loans from 4 or more lenders at a time, compared to just 3.6% 3 years ago. And loan sizes have also ballooned, up 43% in the last 3 years on average. In consumer credit, the report says around half of credit card and personal loan borrowers are juggling another high-ticket loan. So smaller personal loans are putting secured loans, which are larger as well, at risk, because keep in mind, a default in any loan category results in the loans of the same borrower being treated as an NPA as well. Now, if we look at RBI's stress test results, which are not projections but rather outcomes that are based on hypothetical stress scenarios, they suggest gross NPAs could more than double from 2.6% as of September to 5.3% by March of 2026 in the worst case adverse scenario, with public sector banks remaining most vulnerable. But even in the base case, RBI says NPAs are expected to rise in the coming year as per the stress test. Now, capital adequacy remains resilient at 16.6%, but it could drop all the way to 14.3% under one of the stress test scenarios. As for NBFCs, a stress test showed that gross NPAs could rise sharply from 2.9% to 6% under high risk, while capital adequacy could fall to 20.2%. Alarmingly, 15 NBFCs could fail to meet the minimum capital adequacy ratio if severe risks materialize. So overall, the report paints a mixed picture. The system shows resilience on one hand, but on the other, vulnerabilities are emerging across retail, microfinance and consumer credit.
Thank you so much for that update there, Ritu.